When it comes to running a company in Denmark, understanding the annual report requirements and filing deadlines is not just a matter of good governance. It is central to maintaining compliance, protecting your management team, and preserving stakeholder trust. In this video, we will walk through the key deadlines and expectations around Danish annual reports, so you can plan ahead, avoid unnecessary penalties, and ensure that your reporting processes operate smoothly and predictably year after year. Let's begin with the basic framework. In Denmark, most companies are required to prepare and file an annual report with the Danish Business Authority, known as Erhvervsstyrelsen. This applies to limited liability companies, including APS and AS entities, as well as most larger enterprises that fall under the Danish Financial Statements Act. The core rule is clear. Your approved annual report must be filed no later than 5 months after the end of your financial year. For some larger or more complex entities, particularly those in specific reporting classes, such as certain financial institutions or listed companies, the deadline may be shortened to 4 months. But for the majority of privately held companies, the 5-month rule is the operative standard. This means that if your financial year follows the calendar year and closes on 31st December, your annual report must be submitted no later than the end of May. If you operate with a different financial year, for example, closing on 30th June, your filing deadline will be the end of November. Aligning your internal closing, audit, and approval processes to this 5-month window is critical, because the deadline is driven by the financial year-end date registered with the authorities, not by when you feel ready to close the books. Within this overall timetable, there are several intermediate milestones you should manage proactively. First, the accounting close and preparation of the draft financial statements typically need to be completed within the first 2 to 3 months after year-end. This gives sufficient time for any required audit procedures, as well as management review and iteration. If your company is subject to a statutory audit, you should ensure that your external auditors are engaged early and that a clear timetable exists for interim work, final field work, and delivery of the audit opinion. Compressed timeframes at the end of the process significantly increase the risk of delays and late filings. Second, the annual report must be formally approved by the company's general meeting before it can be filed. In many Danish companies, the ordinary general meeting is convened within 4 months of year-end, ensuring enough time to approve the accounts and still meet the 5-month filing deadline. From a governance perspective, it is good practice to schedule the general meeting as early as feasible, both to ensure compliance and to give shareholders and other stakeholders timely visibility into the company's financial performance and position. Once the annual report has been approved, it must be filed electronically with the Danish Business Authority using the prescribed digital formats and portals. This digital filing is the formal step that satisfies the legal requirement. Internal approval alone is not sufficient. Missing the statutory deadline can have tangible consequences. Initially, your company may receive reminders from the Danish Business Authority, requesting that you file without further delay. If the annual report is still not received, the authorities can move to initiate compulsory dissolution proceedings. In practice, that means the company may be ordered to close, and the management can face significant challenges in restoring the company's legal status. In addition, repeated or severe non-compliance may expose members of management to personal liability risks, particularly if stakeholders suffer losses as a result of inadequate or delayed reporting. Even when dissolution is ultimately avoided, late filings can damage your company's credibility with banks, investors, suppliers, and business partners who increasingly monitor public filings as part of their risk assessments. There are also some important nuances to be aware of. Newly established companies have the same obligation to file an annual report for their first financial year, even if that period is shorter than 12 months. If you have changed your financial year, for example, by extending it to align with a parent company, the deadline will still be calculated based on the new year-end date registered with the Danish Business Authority, and you must ensure that your internal calendar and external advisors are all aligned to this revised timetable. Groups with multiple Danish entities should also consider centralizing oversight of deadlines, as different year ends across entities can create a complex matrix of filing dates. One further consideration is coordination between annual report filing and tax compliance. While the annual report and the corporate tax return are separate obligations, the Danish tax agency will rely heavily on your financial statements. And in practice, many companies aim to finalize their annual report early enough to enable accurate and timely tax filings. Synchronizing these processes reduces the risk of inconsistencies and follow-up questions from the authorities. To manage all of this effectively, leading companies take a disciplined, project-based approach to the annual reporting cycle. They create a detailed timetable immediately after year-end, setting clear internal deadlines for closing the books, preparing the draft annual report, completing the audit, and holding the general meeting. Responsibilities are assigned explicitly across finance, legal, management, and external advisors, and regular check-ins are held to track progress against plan. Many companies also employ checklists or simple dashboards to monitor key milestones, ensuring there are no surprises as the statutory deadline approaches. Looking ahead, remember that reporting requirements evolve. Changes to the Danish Financial Statements Act, updates in accounting standards, or shifts in digital filing requirements can all affect the content and format of your annual report, as well as the practical steps needed to file it. It is therefore prudent to stay informed through your auditor, legal advisor, or industry associations, and to build a degree of flexibility into your timeline so you can adapt to new requirements without risking non-compliance. In summary, the critical point to remember is this. In Denmark, your annual report must be approved and filed with the Danish Business Authority within 4 to 5 months after your financial year end, depending on your company type. And missing this deadline can have serious consequences, including potential dissolution proceedings. By planning your closing, audit, and approval processes early, clarifying responsibilities, and monitoring progress closely, you not only ensure compliance, but also reinforce your company's reputation for transparency, reliability, and professional governance. If you are unsure about your specific deadline or classification, it is wise to confirm with your auditor or consult the Danish Business Authority directly, so you can move into your next reporting cycle with clarity and confidence.